in the Facebook group. So it goes into the Business Brain Food group.
Cool.
Make sure that's working and that we have... All right, cool. So we're now live on Facebook as well, which is cool. If you're on Facebook and you're watching this, you are seeing behind the scenes. So this is a behind the scenes recording of a podcast that will be released in a few weeks. But that means you can ask questions if you want. I'm just going to make sure it's all working there. If you are watching this, please just leave me a little comment down below to let me know that you're seeing the live stream and it's all working and that you can hear us okay. Brian, you want to just chat for a second so they can hear you? Make sure your sound's working.
Yeah, g'day everybody. Hope you enjoy it.
I've managed to find an accountant with a personality. Well, actually, they all have personalities, don't they? Just some are not as bright personalities as yours.
Look, they've all got some shade of grey in their personality.
That's not fair on accountants, is it? Hey?
Look, we're really, really good at getting people great quality sleep.
That's what it's all about, isn't it?
Yeah.
All right, cool. So we're definitely live in that group, which is good. Everything seems to be working. Okay, fantastic. So what's going to happen, mate, is I'm going to do the intro. You're going to hear me do that. Before I do that, what I'm going to do is I'm going to hit record, and I'm going to get you hit to do the pre-intro. Now, the pre-intro, you might have heard this on a radio show before or something, is where you say, "Hi, it's Brian Goodridge. and you give yourself a one-liner that you would normally say like at a networking event.
Yeah, okay.
And then you'll say, and you're listening to the Business Brain Food podcast. Are you up for that?
Yeah, let's do that.
All right. So when you're ready, doesn't like me. It hasn't found the SD card. Let's try again. These are the good things that happen. There we go. It's working now.
Perfect.
All right. So when you're ready, you can do that.
G'day everybody. My name is Brian Goodridge. I am your proactive business accountant, and we're here with Ben on the Business Brain Food podcast.
Perfect. All right. So this will all get edited to make it sound better once we get it going.
Yeah, fantastic.
Yeah. All right. So I'm going to do my intro now, mate. You just sit quietly. It'll make sense when I'm bringing you in.
Fantastic.
It'll be about a minute or two for me to do the intro. You ready?
Go for it.
All right. Well, welcome back to another episode of the Business Brain Food podcast. This, my friend, is the podcast that is 100% devoted to taking you and your business to the next level. And the good news is, doesn't matter whether you're just brand new to this business thing, so maybe just scratching that entrepreneurial itch, or maybe like myself and my guest today, and you've been in business for a long, long time, and you've got the scars and the wounds to prove it. No matter what, there is always something new we can do to take our business to the next level. And today is absolutely no different. In fact, today I am joined by Brian Goodridge. Now, Brian heads up a company called Goodridge Advisory, and we're going to be talking tax planning, and I promise you we're going to make this fun. All right, we're going to make it so you enjoy this episode, but not only that, you'll get a stack of ideas and hints and tips to get your business to the next level and maybe minimize some of your tax as well. Before we bring Brian onto the show, I want to remind you that today's episode is brought to you by Maxmyprofit.com.au. The team at Maxmyprofit help you build the business that you imagine. So if you imagined having a business that was more fun, maybe it made you some more money, maybe you looked forward to getting out of bed each morning and actually doing what it is you do, but instead you've got something that was, I don't know, it's yucky, a bit awkward to run, keeps you up at night, and you just don't like it, then you need to talk to the team at Maxmyprofit.com.au, and they'll help you build the business that you imagine. Now, if you love listening to the podcast, we'd love to get your feedback. Head across to your favorite podcast player app, whether that's iTunes, Spotify, iHeartRadio, wherever you're listening to this podcast, and leave an honest review or rating. We'd love to hear from you. And finally, this is being live streamed into the private Business Brain Food Facebook group, and you're missing out if you're not in there. Everybody that's in that group is getting a whole bunch of extra content. They get access to these podcast episodes as they are recorded, along with a behind-the-scenes look at how it all happens. So if you want to be a part of that, along with a discussion with over 1,000 very proactive and excited entrepreneurs, head across to facebook.com and look for the Business Brain Food group. We'd love to have you in there. All righty. So Brian Goodridge is a proactive accountant that looks at tax differently from other accountants. His team's approach is that tax planning needs to be integrated into the overall business planning process. So not only can you minimize tax, and we all want to do that, let's face it, but you can also do it in a way that helps your business growth plans. Welcome to the Business Brain Food podcast, Brian.
Thanks very much, Ben. Great to be here.
Oh, it's good to have you on, buddy. It's good. You know what? I've had 252 episodes. I don't think I've ever had an accountant.
Mate, you were doing so well, and then what happened?
Well, I've run out of good guests. No, just kidding. Just kidding. So, Brian, let's before we jump into the tax minimisation and we jump into the business strategy and planning stuff, because I know that's a lot of people are going to want to hear that. Tell us a bit about your pathway. I mean, what made you decide to become an accountant?
Yeah, so I didn't even start studying accounting when I was at uni, and I did an accounting subject, and I was talking to the lecturer one day, and he goes, you look like you're interested in this. Maybe you should consider changing your degree to accounting. And being an impressionable young man that I was, I decided to do that. Didn't really have a career plan in place, so I kind of fell out of uni into a job and found that I loved it. So here I am today.
There you go.
Yeah.
So you've always been in accounting?
Yeah, ever since I finished uni, I've always been in accounting. While I was at uni and at high school, I probably worked in 10 different other jobs.
What did you do? What was the funniest one you had?
Oh, look, the funniest one I had was back when I would have been in year 9 at school. I had to go to a poultry farm at night and catch chickens and put them back into the cage.
I can only imagine that. That would have been interesting. And where was it?
Yeah, very, very interesting job for a young kid.
Where was that at? Where was this poultry farm?
I was at Rossmore.
Okay.
Yeah, down near Camden.
Down near Camden. So I was just asking that because a lot of places that would have been poultry farms back then are not anymore, the way that Sydney has developed. So things have changed. And so you've been an accountant then. So you went through your 9 jobs, worked out what you didn't like doing, and catching chickens wasn't your future. So you've moved on from that. Instead, now you're counting your chickens before they hatch. That's what I guess counting numbers is all about. So when did you decide to start your own accounting and advisory firm?
So it would have been about 7 years ago, and I was working at a firm in Parramatta. One of the partners went on holidays, and I spent 6 weeks fixing mistakes that if someone I was managing had made, I would have ripped them a new one. And I thought, you know what, I can't stay in this firm and become a partner here because I can't trust this guy to not get us all sued. And I thought, I'm doing it better than one of the partners is, so why not start my own?
Yeah, okay. And so that was sort of how, and you hear a lot of businesses start like that, don't they? I mean, where they feel like they could do it better than the place they're working at. But it's not for everybody, is it, running a business?
No, a lot of people wouldn't be able to handle running a business, and there's a lot of things to running a business that you don't get exposed to as an employee.
Yeah. And so, how long ago was that? When did that happen, when you decided to start your own firm?
Yeah, so I decided about 7 years ago to start it. So I started on the 1st of August 2013. There's a date that's forever etched into my memory.
Yep.
And then it's just kind of grown up from there.
Well, good on you, mate. Good on you. And I know you're doing some good things. And I've got you on the show because the reality is I know a little bit about you because you are working with one of my accelerators. And so, we understand a bit about you, but also know you're a bit different from an accounting point of view. I've met a lot of accountants over the time, and it's great that you've got this approach to helping people build their business. So it's not just about getting the tax done. What led you down that path? What made you decide that was the way that you wanted to grow your advisory?
Yeah, look, I've always been interested in business and how businesses function and operate and how to grow them. And pretty early on, I worked out that whilst tax is really important to, essentially minimise it as much as you legally can, a lot of people were doing things to minimise tax and ignoring the business consequences of them, which didn't give them good results. So they end up in a situation where they've saved a whole lot of money on tax, but they've wasted a whole lot of money in doing it, and they weren't achieving their goals.
Yeah, which is silly, isn't it? Because you hear people sometimes, they'll talk about buying stuff to avoid tax or to minimise their tax, but it's no good buying stuff if you don't need it, is there?
Oh, 100%. Probably the most common conversation I have is a client says, I have a tax problem. I need to buy something. And my response is, okay, you want to buy it, but what's your yield going to be? What's your return on investment going to be on what you're buying?
Yeah. And the answer is probably what? Not much.
It's either, I don't know, or what's return on investment?
Yeah, you're talking
language.
What's your yield on that? I mean,
exactly. So then we go through what that means and then give them a bit of education. So, for example, yesterday I was talking to a client. He has a fairly large electrical business, and he was complaining that one of the utes is dying. And he's going, oh, do I replace the engine or do I get a new ute? And so I ran him through the scenario. Okay, well, if you replace the engine, it's going to cost this much. How long is it going to last for? How much is the maintenance going to be? And then let's look at the same questions with buying the new one and work out which one's going to give you the cheapest cost overall.
Yeah.
And that's something you never thought of before. And so we're going to save him a few $1,000s over the course of the life of those vehicles as a result.
It's funny, as human beings, though, we have this funny way of justifying costs sometimes, don't we? Like, I'm going to save on maintenance. Or I'm going to save on, I get a warranty or whatever. And some of those are, I guess, true, but some of those are just us wanting to buy new stuff, aren't they?
Well, I don't know about you, but my wife's occasionally come home from the shop saying, I had to buy it. I'm saving so much money by buying this.
Yeah, well, I do love a good sale. Who doesn't? You're of going shopping. I actually don't mind shopping. But I want, I like my kind of shopping. Anyway, but there you go. Tell me, do we have any cool disclaimers for today? I've always, like I said, I haven't had an accountant on before. I have had a lawyer, and we had to read out a little disclaimer. Have we got anything like that for today's show?
Oh, look, I'm not going to give you a 5-page document of disclaimers, but essentially anything we talk about today is just general, and it's not specific to anyone's situation. So essentially, if anyone gets any ideas or thoughts from this, you best talk to your accountant, or happy to talk to you myself.
Boom.
Make sure that it applies to your situation before you do it.
Boom, there it is, the disclaimer. We got it.
There we go.
This is general information only, and you got to say it really fast. The content of this podcast is general information only, and not
Nothing I say can cause you to sue me.
There you go. All right, so we got that out of the way. Fantastic. Hey, let's talk tax minimisation. I remember a very, very famous clip of Kerry Packer in court, and I'm sure you've seen this clip. Where
I love this one.
Yeah, and he's being held, taken to task over the fact that he doesn't pay. I think he paid like $50 tax or something in a year or something ridiculous. And so there's definitely a difference between minimisation or avoidance, isn't there?
Oh, 100%. 100%. So minimising tax, we're working within the rules that exist to pay the least amount of tax possible. Avoidance, we're just doing things so that we don't have to pay tax at all, like working in the black economy, not declaring income, hiding it offshore, whatever the scheme is.
Yeah, so that's all the naughty stuff. So what we're talking about is 100% legal and stuff that you can do, and it's smart to do. And if your accountant's not having these discussions with you, you might want to find an accountant that's proactive. Yeah,
exactly. It's really important. So a lot of accountants see tax planning as the thing you do in sort of April, May, and that's it. But my philosophy is that tax planning is part of your business process and it's not a standalone thing. So you need to be doing it continuously through the year. And at the April, May tax planning, where they typically do, let's do these things for this year, that should already kind of been done. And we should be having the conversation around, okay, going forward in the next year, what's your business plans and what can we do throughout the year to further those plans, but also minimise your tax at the end of the year?
Yeah, which is smart. Where do you think it comes from though? Why do so many accountants wait till the end of the year? I mean, I always used to, and I know this might offend some accountants, but I always used to refer to myself as a business coach being like the pit crew. Every lap you come in and we tune one thing up and we send you back out. And then the accountant was the big-breasted lap girl that at the end of the year held up the lap speed. It is. And because they look backwards, don't they? Typically, you look historically at what's happened, and then you report all of that in. But you're changing that. You're talking about looking forward and getting results early, like working out what to do.
Yeah, because looking back, it's fine. You can see what's happened, and it can kind of be interesting to see that I've done this or that or the other. But realistically, if you're looking in the rear vision mirror, you're never going to get to where you're going to. So you need to do that forward planning and be focusing on what's in front of you.
Yeah, so important, isn't it? And from So where do you think that pass thing comes from? Is it something that they train you in accounting school when you do your degree? Is it why is it that so many accountants don't have that proactive planning approach?
I think it is a bit of the training. And look, to be honest with you, I was too busy having a good time to really remember what I did at uni. So a lot of it's training, and typically most accountants are super conservative people, and that's what they know and that's what they're comfortable with, and so they'll stick with that, and they don't want to push out into this other area because it's a bit, they see it as a bit more risky. And what if I forecast something and it doesn't happen the way I forecasted or whatever? I'm going to look like an idiot.
Yeah. Which is interesting, isn't it, that you've touched on that? Because I know, one of the things that we work quite heavily in is teaching people about personality types and understanding how that affects people's decision-making process and the way that they, communicate. And to do the job of an accountant, typically you have to be a fairly highly detailed, conservative, reserved person. That's just the personality type that you would need to be, because what you're doing is repetitive. You're looking at numbers. You need a high attention to detail. And that's why somebody who's a great salesperson is not a good accountant. Because they're just
100%.
different.
But I think that's really important to have those people within an accounting organisation doing the work. But then you need someone sort of above them that can then interpret that and communicate it to business owners, and then also have the conversation with business owners about what's happening into the future.
Yeah, which is why you've built an amazing team, isn't it? You've got a team of people that just sit there, do the grunt work, and
exactly.
You're a bit more out there than most accountants would be. Not many accountants would even be comfortable coming on something like this.
Well, exactly, and you've got to be out there. You've got to be talking to people and educating them around what's going on and how they can benefit and what they need to watch out for.
So let's talk about proactive planning then. You've said that what you do is you like to talk about what's going to happen in the year, business growth and strategy and whatever. What sort of things are we planning when we look at the numbers? What should we be looking at?
Okay, so obviously, and this comes back to a little bit of what you guys do at Maxmyprofit, you need to have that 1-3-5 year plan. And from that, you need to have your budget, your forward estimate budget for the next 12 months. So you can see, okay, to hit our goals, we need to be doing these sort of numbers over that period. And then it's just checking in. So every month you're checking in, how have we gone? So along our path to get to our goal, how have we gone this month compared to where we need to have gone? And from that, we can take an assessment and say, righto, well, we've done better, hopefully. So cool. Maybe we need to readjust our goals and go for something a little bit more challenging. Or what typically happens is they haven't got to the target for the month. So we need to have the conversation around, okay, well, what's gone wrong? And what do we need to do to get us back on track for the remaining part of the year?
Yeah, okay. And so you're looking at these numbers every month?
Yeah, it's really important to look at it every month, and it's really important to understand how the numbers interact with each other. So, if we make $1 worth of sales, what are the costs that are going to be associated with that? So it's, going back and looking at let's say we're in manufacturing, okay, so our cost to manufacture something is X percentage of the sales, then we have an overhead allocation on top of that and whatever else. So we can start to project forward how much we need to be selling in order to get to where we need to get to. And there's a whole lot of other ratios and statistics that are important, just they vary industry to industry.
Yeah, okay. And are you a lot of accountants would not meet with their clients every month. So how are you doing this? What is a business owner has to ring their accountant once a month or?
Yeah, so what we're doing is now that we've got all these lockdowns, we're just scheduling Zoom calls with clients that we're doing monthly catch-ups with. And so it's actually proven to be quite good because I can then share my screen and go through the numbers and point out this and point out that they need to be aware of.
Now, when you say you're proactive, by the way, listeners, this is what we're talking about. So if your accountant's not meeting with you every month, you're not proactive, or at least every quarter, right? It should be, is quarterly enough or not?
Quarterly is okay if you've got a really well-run business, but it's not going to give you the information in a timely manner to correct things if we're going off course really badly. So, if we meet quarterly, it's probably going to be halfway or towards the end of the fourth month. So we've gone 4 months before we're looking at the figures to know what's going on. So that's a long time for something to be going wrong and not to be aware of it, not to be course correcting.
Yeah, okay. So, and I agree with you. I think monthly is what needs to happen. And I think it's scary to think there's probably a lot of people that are not meeting with their accountant until maybe even 6 months after the year is over.
Yeah, look, you get people that don't meet until 9 months after the year's over and they look and go, oh, that happened. Well, that's a problem. Oh, well, it's happening again this year.
You don't, and they're the lap board holders, aren't they? They are holding the lap board up. Like.
They're the guys that typically don't finish the race.
Yeah. So we want to make sure we stay. So we're meeting with our accountant monthly. Make sure we're looking at the numbers. We need to have some goals set. 1 year, 3 years, 5 years. 100%, I agree with you. It's the same philosophy that we teach and coach. What other things are we looking for? So do you help people set up? Like, is there key indicators? Is there numbers we should be looking at? Levers? What from a tax point of view as well? I mean, how do you stay on top of all of that? Like, there's a fair bit to do, isn't there?
There's a fair bit to do. So what needs to happen is every month when we're meeting, we need to be projecting forward what looks like is going to happen to the end of the year. So there's a couple of things in your question, Ben. So levers, KPIs, all that stuff. We need to identify what the important ones are for each particular business. So we're reporting on those. And then we have the projection forward so we can see, okay, apart from the business result, is it going to meet our goals or not? From a tax point of view, once we get to the end of the year based on what's been happening, we think we're going to have a tax bill of whatever it is. And let's start looking at what can we be spending that's going to help us achieve our goals, but also to minimise our tax.
Interesting. Spending so we can achieve our goals.
That's right.
There's nothing wrong with paying tax, is there?
No, look, I personally would love to be in a situation one day where I do my tax return for my business and I've got $1 million tax to pay, because it means I've made a hell of a lot of money, and I do my utmost to minimise that. But just that number means I've made an absolute fortune for the year.
Yeah, it means you're doing pretty well.
Yeah, exactly.
On a side note, do you have like a collection of calculators or anything like that? I've just always just want to know, as an accountant, like, is that something that you collect?
Oh, you know what? That'd be amazing. But I'm more of a spreadsheet kind of guy.
Just asking. Just had to check.
Although one of our girls that works for us, on her desk at home, she's got an old calculator with the roll of paper that prints onto the paper. She's typing the numbers in. So
one of the ones with the lever on the side.
That's it. So maybe I've hired the accounting nerds more than being one.
And the green hat, the green see-through peaked hat.
I was thinking of getting one of those with our branding on there for everyone in the team to wear. We'll have that as a photo on our Facebook page.
Very stereotypical, isn't it? All right, well, cool. So minimising, let's talk about tax minimisation, because I know a lot of the listeners want to learn more about that, and everybody would love to minimise their tax. So when it comes to minimising tax, what are some of the things that we should be thinking about to make sure we're not spending too much?
Okay, so the very, very first thing is don't spend any money just to minimise tax. So to make a really simple example, if we were to spend $100 to minimise tax and our company tax rate was 30%, we'd save $30 worth of tax, but there's $70 we've spent that is gone. And unless that thing we spent the money on is going to make us some money to recover that 70, we're actually worse off than we were if we had paid the tax.
Yeah.
So that's the first thing to keep in mind when you're doing this sort of stuff.
You see that happen a lot, like people buying stuff just because they don't, like, they're that anti-paying tax, they just buy something and then go, oh, shouldn't have done that.
Yeah, there's a lot of people doing it. So it's really interesting. We've got a client that has $1.5 million sitting in term deposit in the business. They've done really, really well. And when we talk about tax planning, they typically go, oh, we don't need anything. Yeah, we're not going to worry about it. And then a lot of other people that aren't doing as well, they'll go, oh yeah, what can I spend money on?
Yeah.
So interestingly enough, no one ever wants to pay accounting fees in advance, but I'll still give them that option.
I think, what's interesting, you've just touched on as a mindset thing, isn't it? Like you said that, somebody with all that, who's done really well compared to somebody who's not done so well. And, they're out there spending money trying to minimise tax that they're not really going to have to pay anyway.
Yeah, exactly.
Yeah, isn't that interesting? All right. So don't buy something you don't need. What other tips? How else can we make sure we're minimising our tax?
Okay, so contributing more to your super to bring it up to your cap, so a $25,000 cap per person. So that's a good way to save tax and also essentially keep the money. So it's investing, compounding for your retirement.
Is that like per director? Is that or per owner? Is that how that works? Or
yeah, that's right. So each individual has a $25,000 concessional contributions cap each year. You just need to make sure that you calculate how much super you've put in there through your wages up to that point, so you don't go over the cap.
What happens if you go over the cap?
If you go over the cap, then there's an excess contributions charge.
Of course.
Interesting enough, that's 15%. The tax rate in super is 15%. There's a small other component, might be a couple $100 typically that you pay. So there's actually a planning opportunity that some people look at where they say, I don't mind paying the extra tax because it's going to be less than what I'm paying personally anyway.
Yeah.
So we'll just throw in extra over the limit and pay that bit, but overall we've paid less tax.
And with that would depend on how old you were, I guess, as to whether you would make that decision, because you might, if you weren't thinking about getting access to that money real soon, maybe you wouldn't want to do that.
Yeah, look, that's the downside of this. So if you're quite young, like you and I,
Yes,
then
very young,
then putting the money in is not as attractive because you might have 20, 30, 40 years before you can get access to it. And I know that I've got better things to do with the money than have it sit there doing nothing for that period of time. Having said that, if you're doing particularly well, it might still be worth doing it because you'll still have other money to do whatever it is you want to do, and it'll have more time to compound in the fund. As an older person, as you get older, then you definitely want to be taking advantage of that as much as you can.
You can't, like I said, you can't put a huge amount in there anyway.
Not on claim a tax deduction for it, no.
Yeah. Oh, wait. So you can put whatever you like in there, but to claim the tax deduction, maximum 25 grand per person.
Well, yeah, you can put up to $100,000 of non-tax deductible contributions in there a year, but unless you're really wanting to boost up your super balance, then what's the point? You're not going to get any tax benefit out of it.
Yeah, unless what if you were using that money then to invest? If you had a self-managed super and then you were buying property or something with that, would that then make sense?
Yeah, depending on what your investment is, and you got to be smart with your investments. I know we're going to go a little bit off topic here, but I think it's important. A lot of people, they've got their self-managed super fund and they're investing in it, but they really don't know what they're doing with investing, so they don't do very well with it. I've seen that with a lot of people buying geared properties in super. They buy off-the-plan apartments, which tend to fall in value once they've been completed. So it's a great idea, Ben. You just got to make sure you do your research and you're making smart investment decisions.
I think, there's always a risk, isn't there, in those things? And I think a lot of people are sold to. That's the problem. They get sold to, and by people who aren't experts at giving financial advice, unfortunately. We've seen that happening.
Yeah, I've seen a lot of people being sold to because the person selling it isn't considering their client's best interest, but they're considering the commission that they're going to get from the developer. Yeah.
It was like with the whole COVID-19 thing. I remember seeing real estate agents were telling tenants they had to access their super to pay their rent.
I saw that, yeah.
They got stopped pretty quickly. So no, you can't do that. You cannot do that. All right, so superannuation. What else could we be thinking about from a planning point of view?
Yep, so we can prepay expenses. So we can prepay expenses 12 months in advance. Now, the downside of that is we don't get the tax deduction in the following year, so we need to come up with something more creative to deal with the tax consequences in the subsequent year. And that goes back to what we were talking about earlier, where you need to be looking at this as an ongoing process. So we're not just minimising tax this year and giving us a massive tax bill next year as a result. If you're getting towards the end of June and there's some invoicing you need to do, you might consider holding that off for a couple of days and invoicing in July if you're on an accruals basis. Looking at what sort of, if you've got a lot of plant and equipment, is there anything that you can write off that you no longer have, or it's broken or whatever, so we can clear that out of the accounts, claim the deduction for writing off the balance. And then we can look at how we distribute profits and that sort of thing. So if we're operating a business through a trust, we'll look at who we distribute the profits to. So we might have mum and dad who run the business and their parents are self-funded retirees where their only income is tax-free super pension. So maybe we'd make a distribution to them and use their tax-free threshold or lower tax rates.
Yeah, okay. Now, can you explain asset write-off? Like you just said, if it's broken or we don't need it, we just write it off. But a lot of people probably don't. That's jargony, right? So what for a business owner that doesn't know what that means, what are you saying? You just write it off. I mean, when something gets written off, usually insurance paid out and we go and buy a new one. But it's not that kind of write-off, is it?
No. So let's say we've got a machine that we bought for, I don't know, $100,000 and over the years we've claimed depreciation. Now it's worth $25,000, but it's broken down. It's sitting in the corner, and we have no use for it anymore. And it's probably never going to use it anyway. So it's got no value to the business. We can just say, okay, well, it's not worth anything. We'll write off the value in terms of we'll claim depreciation for the balance.
What if it's not broken down and sitting in the corner, not being used?
Well, that's a bit more of a grey area. So you'd want to sort of consider what's going to happen in the future with it before you do it.
Yeah, okay. So if it's something you still use, it still has value. You can't write something right down to zero just because you've got to the 5th year of writing the stuff down or depreciating something.
No, not unless it's only got that 5-year write-off period. It's more a case of, the thing's broken, or we're going to toss it out anyway. It's got no value to our business.
So what happens with the instant asset write-off that they're offering at the moment?
Oh, this is really interesting. So at the moment, if you buy an asset and it's installed ready for use by the 30th of June, you can claim a tax deduction for it as long as the value is less than $150,000. So it's a really good opportunity to save some tax. The issue that I found in talking to most of my clients about it is that we're in this really unusual situation and we don't know how long it's going to go for, and we don't know what the economic impacts are going to be. And so my counselling generally has been, unless you need it really for what you're doing now and you're going to make money off it right now, hold off buying it until we've got more certainty in the economy.
Yeah, that's interesting, isn't it? But so that instant asset write-off, can you write off 100%?
100%. As long as the asset is under $150,000, right now you can write off 100%. Just keep in mind, if you're looking to buy that fancy car, there's still the luxury car threshold, which is just a little bit under $60,000. So we won't be able to get the whole lot for that if we go over it.
So if you buy a car under 60,000, you can write the whole lot off. What happens if you sell it in 3 years' time? Do you have to pay capital gains tax then because you've written it off?
No, then there'll be an adjustment coming back the other way. So you might find that there's, depending on your depreciation method, if you're using the normal method, there'll be a taxable adjustment and you'll have a little bit of income come back into your business for tax purposes. If you're using the simplified depreciation method, all it'll do is reduce the pool balance so that you can claim less tax deductions for depreciation going forward.
Yeah, okay. So if you've, so just so we can help people understand this, so you're going to do an instant asset write-off, but you still have to depreciate it.
So you do your instant asset write-off, and as far as depreciation is concerned, it's completely depreciated, it's gone. If we sell it later on, then there'll be some sort of adjustment, whether it's an income adjustment or whether it's just reducing the value of your assets you're depreciating at that point.
Yeah, okay. So you can't just buy something and sell it next year and not be.
That'd be amazing.
Just checking for a friend. All my friends that are listening in, that is. All right, so that's cool. So we've got the instant asset write-off. And now on the 30th of June, 2020, because some people might be listening to this after then. If you're listening after then you've missed that opportunity. But if it's before then and you need to buy something, it could be a good strategy to minimise your tax for this financial year.
Yeah, exactly. So make sure that you need it, you can make money off having it. And if you do that, then it's a great opportunity to minimise tax.
Yeah.
If you're listening to this after the 30th of June, 2020, don't stress. Between the 1st of July and the 30th of June, 2021, you can claim 50% of the value straight away as a tax deduction.
Okay, so there's still got some incentive, because I heard it was going back to being what it was before, which was a maximum, I think, of $1,000 or...
Oh, look, they keep talking about bringing it back to $1,000. Every year they go, next year we'll bring the instant asset write-off back to $1,000, and they never do it. So I can't see them doing it for this next financial year, maybe the one after that.
A bit like the boy that cried wolf, eh? Not going to happen.
Well, politicians don't want to lose votes, so yeah.
Okay. Now, besides the instant asset write-off, is there any other incentives that we need to know about before the 30th of June?
There's not a huge amount of other tax incentives before the end of June, apart from those stimulus packages that people should be aware of. So when they lodge the BAS, they get a minimum of the $10,000 credit for eligible employers. There's the JobKeeper payments, all that sort of stuff. Not so much tax planning things. It's just incentives that are out there at the moment to stimulate the economy.
Yeah, okay. So from a tax planning point of view, the key things right now is look at the instant asset write-off. Think about super if you've got money that you can put into super.
Yep.
Think about if you need to buy something right now that's, if you've got to buy it, then now's a good time because of that instant asset write-off as well.
Yep. Think about prepaying expenses that are coming up over the next 12 months.
Yep, so prepaying. So, and how would you do that? You just go to a supplier and say, hey, I want to buy 12 months worth.
Yeah, so you might say, to your landlord, I want to pay my rent 12 months in advance. They'll be pretty excited about that.
They would.
Yeah. Or, talk to your accountant about paying their fees 12 months in advance.
Would they be excited by that?
Oh, of course. And it's just, obviously, it's a sensible tax planning opportunity.
Yeah. I mean, so what we offer is to prepay. We actually give people an incentive because not only do they save some money, they get the tax write-off or the tax incentive straight away, but we get to use the money straight away to grow our business. We can pop it into marketing. Yeah,
it's win-win for everybody. So look, the prepaying, it's only for 12 months. So if you go past that, you can't claim the extra part. So it's a useful way to get some tax incentives, tax benefits there. Just keep in mind, if we're prepaying an expense to get the tax benefit this year, next year we're not going to have that tax benefit. So by prepaying, we kind of get on the wheel of having to continually prepay to keep up with it.
How would that work with things like services that you haven't received, so long as they get invoiced, I guess? And what about products? Because if you couldn't pre-buy products, could you? Because they sit in your balance sheet anyway, separate.
Yeah, so if you got trading stock, then you can't. There's no point pre-buying because you'll end up having closing stock sitting in your balance sheet and it comes out of your profit and loss. But if you were, let's say you were an electrician, you don't have trading stock, you might pre-buy some cabling or something like that because it's going to be useful to you, but it doesn't come back out.
Because it doesn't sit there as a stock at hand.
Yeah, it's not a trading stock item.
Yeah, okay. So there's something else as well. All right. And so, from a planning point of view, how, you meet with your clients monthly, but what if there's people listening to this that haven't met with their accountant all year? Is it too late or have they still got time to do something?
No, it's not too late. So what I'd say is you need to go and meet with an accountant soon, like definitely before the end of May. And you need to get your financials up to at least a draft stage to the end of April so you can see what's going on in your business and what amount of tax we might potentially be looking at when we project it out and start coming up with some strategies. So just keep in mind, the later we leave this, the harder it's going to be to do anything useful because we'll run out of time.
Yeah, okay. And is there anything that maybe people aren't claiming for that they should be? What's the funniest thing you've seen or the oddest thing, or is there something that that we're as consumers not thinking about that we should, especially now we're all working from home? I'm sure there's stuff we're not going to even think about.
Oh, you're working from home. So if you're working from home, keep a 4-week diary of your hours of working, and then we can start claiming an apportionment of the internet and electricity and everything else. The ATO's increased the cents per hour rate. I think it's up to 85 cents, which isn't really that much. So you want to keep your diary so you can substantiate how much of all those expenses you can claim. And you'll probably find that you can get a pretty big claim happening as a result of that.
Yeah, okay. And what's the funniest thing you've seen someone try to claim? Has there been something really funny?
So when I first started, you could still claim tax offsets for medical procedures. And we had a client at the firm I was working at that claimed $20,000 worth of cosmetic surgery.
Oh, really?
Yeah.
Well, I'm not going to ask what it was. No. Was this a female client?
Yes, it was.
Fair dinkum.
Yeah.
Stuff you can claim for. I mean, I haven't claimed for any of my plastic surgery, Brian.
You haven't?
No. Because it's consisted of like a pack of Band-Aids. That's been my plastic surgery. I don't like needles, let alone getting cut up. Can you imagine that?
Yeah, I don't know how people do it, but anyway. So yeah, that's what she claimed, $20,000 tax offset on that. She got an amazing refund that year and reinvested it back into herself.
And let's quickly talk about cars then as well, because I know you mentioned cars and the luxury car threshold. A lot of people don't realise that. They don't realise you can't go and buy a Porsche and claim the whole thing, can you? Even if you stick your company name all over it.
No, you can only claim up to the luxury car threshold, which, as I said before, is just a little bit under $60,000, and the rest of it's not tax deductible. But where they really sting you is if you've got that in your company, the whole value of that Porsche is subject to fringe benefits tax.
Wow. And what's fringe benefits tax? What does that mean?
Okay, so all that means is that the company's provided one of its employees with a benefit that's not salary and wages. And so the government back in the 80s decided that they should tax this, and it's taxed at the highest marginal tax rate, so 47%.
Yeah.
So once you've worked out the fringe benefit value, then you're whacked with the tax.
So if you're going to buy a Porsche or anything like that, a car over 60 grand, are you better off buying it personally after tax dollars?
Yeah, usually you are. What I'd say is, again, do the calculations and work out after tax what the numbers are going to look like, and then make an informed decision from that.
What if that car is used for business purposes?
So the only way you might be able to get around it is if you've got a separate company set up that leases cars.
Yeah.
So you've got the separate company set up, you put your Porsche in there and your Ferrari and whatever other cars that you're looking to buy, Ben, in there, and then you have your website set up where you lease them out. Sorry, mate.
A whole list of luxury sports cars, of course, yes.
Yeah. Have you bought that Bugatti yet?
Not yet, mate. Not yet. I'm just next effective way to get it.
Yeah, so you'd have that company set up there. You'd own all your luxury cars in there, and you'd lease them out to the general public. So, someone might want a Porsche to do whatever for a weekend, and then you can lease it back to yourself when you want to drive it. So that might be one way to get around that.
Then you're a hire company, yeah. But if you can't,
exactly.
It's like you can't say it's a promotional item. And
No. The ATO are across all that stuff.
They're all over it.
Yeah, people doing those type of things back in the late 80s and the 90s, and it's all been weeded out.
Once again, asking for a friend. All right, well, we're pretty much out of time. Is there anything I haven't asked that I should have asked, Brian? Is there something that you want to share that maybe I didn't ask?
Look, it's really important that people don't look at tax planning as a standalone thing. It's got to be integrated into the planning of the business, cash flow management, all that sort of stuff. And probably the one other thing I just want to make a point on is most of the time when someone tells me they've got a tax problem because they can't afford to pay their tax, it's not a tax problem. What they've got is a cash flow management problem, which is a whole different beast. But once we get that sorted out, the tax problem is no longer a problem, because once the tax is minimised, there's money there to pay it, and money left over afterwards to keep doing whatever they need to do. Yeah,
good distinction. So if you feel like you've got a problem with tax, with being able to pay your tax, it's not that you can't pay your taxes. It's not a tax problem, it's a cash flow problem. That's why you can't pay tax.
Yeah, exactly. If you get to the end of the year and your tax bill is X, and you don't have that sort of money in your bank account, then you've got a cash flow problem. You've got a problem with how much you're spending. You've got a problem with how you're collecting money, all that sort of stuff. And that's what we need to be dealing with, rather than how do we minimise this tax any further, because it's probably been minimised all the way anyway.
Yeah. And it's what I call the Bermuda Triangle of money in business.
Yeah.
Because you've got P&L, right? And your P&L can tell you you've got profit. It doesn't mean you've got cash flow.
Yeah, I was having this discussion last week with a client, and they're going, well, how can we possibly have made that much money? We don't have the money in the bank. And I said, well, let's have a look at your balance sheet, and I can see that you've drawn out this amount of money out of your director's loan. So that's where your money's gone. It's gone to whatever you're spending personally. Yeah. And so that's a real problem, I think, for people to understand. Because so if you think about the correlation between the P&L, the profit and loss statement, the balance sheet, and your cash flow forecaster, that's what I call the Bermuda Triangle. That's where everyone gets lost, right? So I think it's really important to understand. I think you're very good at this, Brian, is making sure clients are planning not just to make sure that they're not paying too much tax, because no one wants to pay too much tax, but have they got enough cash flow in their business, not just to pay themselves, but also to be able to do what they need to do from a trading perspective as well, 100%. And, it all comes back to the cash cycle. Yeah. The most important part of any business is that cash cycle. And once we get that sorted out, a lot of other things start to become pretty easy.
Now, I'm going to be cheeky and ask for you to throw in a freebie, because I know you're probably already busy, but are you able to offer listeners the chance to catch up with you for like a strategy session or something if they've got some burning tax planning or business planning question?
Yeah, 100%. I'm happy to do a a complimentary 15-minute Zoom call with anybody who wants to come and talk to me.
All right, cool. So what I'll do is I'm going to put that into the show notes, gang. I'll get a link off of Brian and I'll put it into the show notes, and I'll also put it onto the Facebook feed. And that way, if you want to have a chat with Brian about because like we said at the beginning, this is general. Everyone's got their own unique situation, and it would be better that you have a chat with him directly. Now, if your accountant's not talking to you on a monthly basis, then you need to talk to Brian, because it is very, very important for you to be across everything going on in your business from a financial aspect, but not just tax planning, but cash flow planning, making sure you're profitable, making sure that you're, that you comply, making sure everything's right. And if you're not proactively looking at that, it will bite you in the bum. I can guarantee it. And I'm sure Brian's seen plenty of that where people have rocked up and it's too late to save them from paying too much tax or the cash flow issues that they've got.
Oh, the number of conversations I've had where it's on lines of, if you had seen me before you did this, we'd be able to save this much tax, but now it's too late.
Yeah, perfect. All right. Well, thanks, mate, so much for coming on the podcast. I know you've been pretty busy with all things COVID and helping clients plan coming towards the end of the year. So I appreciate you taking out and carving a little bit of time out for us today, mate. It's been insightful.
You're most welcome, Ben. Thanks for having me on.
Dare I say it, a bit of fun. Well, if you've enjoyed today's podcast episode, head across to your favourite podcast player, leave an honest review rating. We do read them all. We love to hear from you. We love your feedback. And if you would love to leave a review, we'd read that as well. We love to get it. We'd love to hear what's working well, but you can also tell us what you'd like us to improve. Just a reminder that today's podcast episode was brought to you by Maxmyprofit.com.au. If you I can't even say what I'm trying to say anymore. My tongue is all twisted. What I'm trying to say is, if you haven't got the business that you imagined having, let's say the business that you've ended up with is harder to run, or let's say that business is not fun anymore. You don't look forward to getting out of bed each morning to run that business. It's not what you imagine. Most people, when they start a business, imagine something that's going to be more fun. It's going to make you more money, give you more time to do the things that you love in life, whether it's spending time with the family or traveling or buying the toys that, make your day a bit more exciting, whatever it might be. And they end up with something that's a bit hard to run, lacks cash flow, and unfortunately zaps you of your energy, and quite often can cost you not just money, but relationships as well. So if you haven't got the business that you imagine, you need to talk to the team at maxmyprofit.com.au. Now, on a final note, this was live streamed into the Business Brain Food group, where we can chat to you directly after the show and before the show. So if you are not watching this live inside the Facebook group, can I encourage you to get in there, go to facebook.com, look for the Business Brain Food group, because besides these live streaming in there, we also have a constant chit chat going in there with over 1,000 entrepreneurs, and you may be missing out on something critical to helping you take your business to the next level. Well, thanks for tuning in. It's been absolutely my pleasure for hosting you today. Thanks again to Brian for joining us.
Thanks, Ben.
Great having you on, buddy. And until next week, have a very profitable day. See ya. There we go, mate.
Very good. Thanks, mate. I really appreciate you having me on.
That's my pleasure. And hey, Nicole, how you going watching the live stream there? Good to see you there. We need proactive accounting advice. Yes, we do.
There we go. I can happily help.
So what I'm going to do, for those of you that watch the live stream as well, the podcast episode doesn't come out for a couple of weeks. So the show notes that we were referring to won't be written up until it gets listened to by the amazing Mikey over in the UK. He writes the show notes up. But I will get a link off of Brian. I'll get that from you today, buddy, and we'll stick it into the Facebook group.
Definitely.
And that way, because it is important right now to get on top of this stuff, right? More important than, it's always important, but right now it's more important than ever to get on top of your business finances and make sure that you're planning, because if not, you're going to end up getting caught short, and you don't want to get caught short. That's for sure. All right, I'm going to end the live stream. So thanks so much, everyone, for joining us in the live stream. Let me finish that up.